Welcome back to Return My Capital. Today we're going to take a look at five of the leading defense contractor, defense industry companies. It's going to be Lockheed Martin, RTX Corporation, Northrop Grumman, L3Harris, and Huntington Ingalls. We'll compare these. We'll look at previous performance. We'll look at some of the underlying metrics. So let's dig right in. Here you see Lockheed Martin, ticker symbol LMT, trading for $473. Lower half of the 52-week range with 418 on the low end and 618 on the high end. It does carry a 17 forward price to earnings ratio, pays $13.20 in an annual dividend, almost a 3% yield, 2.8%, very negligible short interest of 0.99%. This is a massive company, I believe the second largest defense contractor, 110, almost 111 billion on the market cap. Over the past 1 year, up 2%, so slightly above being flat. Year to date, it's down almost 3%. Over the past 5 years, up 21%, and then over the past 10 years, up a pretty fantastic 145%. 2024 revenue was at 71 billion, expecting a fairly solid increase for 2025 up to 74.5 billion. You see on the EPS side of things for 2025, we're expecting things to be down about 2%, followed by years of up 9 and up 4.7% on the EPS going out into 2027, which would bring the price to earnings ratio down to about 15 at current share price levels. Sales are expected to expand out to nearly 80 billion by 2027 with mid to low single digit revenue increases. Profitability is pretty solid. You've got a gross profit margin slightly over 10%, and then the net income margin at 7.7%. The companies that we're going to cover today, by no means are they your mega cap tech names with the unbelievable margins. These are capital intensive businesses, a lot of employees, a lot of manufacturing, a lot of research and development. But that being said, still pretty solid margins. Balance sheet on this 110, 111 billion market cap company, you've got 20 billion in debt offset by 2 billion in cash. And dividends, again, like we mentioned, a 2.8% dividend yield on Lockheed Martin here for an annual payout just over $13. Payout ratio is pretty healthy, 44.5%. They've been growing the dividend on a 5-year CAGR basis anyway for 7% here, 22 years of growth. So you would expect that a company like Lockheed Martin will become a dividend aristocrat in 3 short years. And they went ex-dividend most recently on March 3rd and paid out their last quarterly dividend on March 28th. You see the dividend growth history here on this chart. Back in 2014, the annual dividend was $5.49. 10 years later, it was up to $12.75. So pretty fantastic dividend growth. Let's go ahead and look just a little bit further here. So you see here the previous dividend payout on March 28th. This yield here. So like we mentioned, it's a 2.8% dividend yield. Your 3-year yield on cost would be 2.9%, and your 5-year yield on cost would be 3.4%. In terms of dividend growth, like we talked about, a 7% 5-year CAGR on that dividend for Lockheed Martin and a almost 8.6% 10-year CAGR to that dividend. So the dividend growth has been slowing down a little bit in the last 5 years compared to the last 10 years, but the dividend is extremely safe, extremely well covered. The payout ratio is well under 50%. See again the dividend history here over the past 10 years. It's steadily up and to the right. Moving on to Raytheon Technologies, RTX Corporation, there was a merger or a split about 5 years ago from Raytheon into RTX and a couple other business units. You'll see that here on the 10-year chart. So back in February of 2020, shares were trading for almost $157 and then spiked down to just under 100. Well, that was during a restructuring in the beginning of 2020 there. But over the past year, RTX has performed incredibly well, up 27%, and even year to date up 11.5%. In the past 5 years post that breakup, if you will, still shares are up 120% for RTX Corporation here. Upper half of the 52-week range, 129 today. I'm recording this Monday, May 5th, and that 52-week range would be 99 on the low end, 136 on the high end. Trading for a little bit more of a premium valuation compared to Lockheed Martin. Price to earnings on a forward basis is nearly 22. You do get $2.72 in an annual dividend for a slightly over 2% yield, essentially zero short interest, just 0.64%. And this is the largest of the five companies that we'll talk about today, I believe. I believe RTX is larger than Northrop. Yep. RTX market cap almost 174 billion. 2024 revenue was the highest ever for this company at nearly 81 billion. In 2023, it was closer to 69 billion. For 25, we're expecting 84 and a quarter billion, followed up by 89.2 billion. You see the EPS growth looking out for the next 3 years, 4.3, 11.8, and 10.8%. If that were to hold true, that price to earnings would come down to about 17.5 in 2027 at current share price levels. And then you see that mid-single digit sales growth of 4.4, 5.8, and 5.9% for the next 3 years. Profitability is similar to Lockheed Martin. Gross profit margin 19.5%, net income margin 5.6%. And then looking at that balance sheet, you've got 43 billion in debt offset by 5.2 billion in cash. Again, just a slightly over 2% dividend yield on RTX, so a lesser yield here. The payout ratio is about 43%, and they've been growing that at about a 6.4% annualized rate for the past 5 years. RTX is a dividend aristocrat at 31 years of dividend growth, and the upcoming ex-dividend date will be May 23rd with a distribution date of June 12th. Looking a little bit more at their dividend history here. So let's see here. That dividend growth rate on the 3-year, 7.3%, on the 5-year, 6.4%, and then the 10-year CAGR is 5.2%. So with RTX, they are actually accelerating recently that dividend growth, as opposed to where we saw with Lockheed Martin. That 10-year CAGR, the dividend was significantly higher than the 5 and the 3-year. So with Lockheed Martin, the dividend growth has been slowing down recently. That's exactly the opposite with RTX here. They are actually accelerating the recent dividend growth. And you'll see that reflected with your yield on cost. So just over 2% current forward dividend yield. A 1-year CAGR would be 2.5%, or excuse me, a 1-year yield on cost would be 2.5%. That 3-year yield on cost would be 2.6%. And then this is really where you see it start to take effect. That 5-year yield on cost would be 4.3%. So that's where you start to see the compounding nature of dividend growth. The third company would be Northrop Grumman Corporation, ticker symbol is NOC. Shares are just under $500, up 4% over the past year, up 5.2% year to date. Over the past 5 years, it's up 53%, and over the past 10 years, up a fantastic 212%, just above the midpoint on the 52-week range, which is 418 on the low end, 555 on the high end. Forward price to earnings of 19.5. You do get $8.24 annualized in that dividend distribution for a 1.7% yield. Negligible short interest of 1.6% on this $71 billion market cap defense contractor. 2024 revenues were at 41 billion. In 23, we were just over 39 billion. Expecting 42.2 billion for 2025, followed by 44 billion in 2026. We are expecting a slight pullback of 3.4% to that EPS for 2025, but followed up by real strong growth in 2026, up 14%, and then nearly 8% the year after in 2027, and low single-digit revenue growth expected for the next 3 years. Profit margin is similar to the first two mentioned, a little over 19% on the gross profit margin and slightly over 9% on the net income margin. Balance sheet, you've got 18 billion in debt and nearly 2 billion in cash. Again, a $70 billion market cap company. The dividend yield is just under 1.7%, just over $8 in an annual distribution. It is a quarterly dividend payer, almost a 36% payout ratio, so very healthy. And you'll see that reflected with the strong 5-year CAGR of that dividend, 9.3%, 21 years of dividend growth for Northrop Grumman. So 4 more years to go until they lock in that dividend aristocrat status. Looking at the yield of Northrop Grumman, you've got the forward yield of 1.68. Your 1 year yield on cost is 1.76. 3 year, not much higher at 1.78, but your 5 year yield on cost is 2.55%. And the 10-year CAGR of that dividend is 11.4%. 5 year is 9.3 and 3 year is 9.5, let's say. So pretty consistent, right around that 10%. Every single year, you're getting that dividend growth, which is exactly what you want to see. See here the dividend growth chart over the past 10 years. Back in 2015, paying out $3.10 every single year. 2024, $8.05 every single year. Fourth company is L3Harris, ticker symbol LHX. This is going to be smaller than the first three we mentioned at a $41 billion market cap. Still a massive company, of course, but significantly smaller than the first three. Over the past year, flat, but up 2%. Year to date, up 4%. Over the past 5 years, nothing to write home about, but up 16%. But you kick it out a little bit further and look over the past decade, up 178%, just under the midpoint on the 52-week range. So 219 per share today. Low end would be 193, high end would be 265. Price to earnings ratio just under 21, so a little bit more richly valued than Northrop Grumman. You get $4.80 in that dividend distribution every single year. 2.2% yield, 2% short interest. So as we've seen so far with all four of these, really the short interest just isn't there. Very stable, a lot of contracts built up. And we'll actually take a look at all five of these compared against each other in a spreadsheet in just a moment. But there is an impressive book of business in terms of government contracts that have already been awarded to these companies. 2024 revenue to 21.3 billion. The year before that was 19.4. We're expecting 21.5 billion for 2025. So not much growth from 24 to 25, but then looking out into 26, we're expecting nearly 23 billion. You see here the decline in EPS for 2025 down 20%. But you are following that up with years of fairly explosive growth for this type of business of 15.5 and nearly 14% into 2027. Sales growth is low to mid single digit. Maybe you're noticing a trend there with these companies. Gross profit margin, pretty fantastic at 26%. Net income margins 7.5%. 12.25 billion in debt, offset by just over $500 million in cash. The dividend yield is 2.2%, and that payout ratio is a fairly minimal 37.5%. They've been growing the dividend at a nice 9% 5-year CAGR, 23 years of dividend growth, so just 2 more years to go for aristocrat status. The next ex-dividend date will be June 3rd with a distribution date of June 18th. Here you're looking at that dividend growth history. Some real nice growth from 2014 all the way through 2022. It's been pretty flat since then, but still growing. Back in 2014, you were getting $1.78, and now you're getting $4.64. So over the past decade, pretty fantastic dividend growth. Taking a look at the yield on cost, you're getting 2.18% today. Your 1-year yield on cost is 2.21. And your 3-year 1.94, as the shares haven't done a whole lot. But you start looking out a little bit further at that 5-year yield on cost, you're at 2.5%. Looking at the CAGR rates, the 3-year CAGR has been pretty slow at just 3.8%, but the 5 and 10-year are both over 9%. So it's been slowing down as we saw on that dividend growth history chart. Past couple years, dividend growth has been fairly minimal, kind of just keeping up with inflation. You look out a little bit further, and it's much closer to that 10% annualized. The fifth company and the last company that we'll look at before we compare the performance and then the metrics side by side, you've got Huntington Ingalls Industries, HII. This is the big shipbuilder, but we'll get into the contracts for all 5 of these. Trading for nearly $233 per share. just over the midpoint of the 52-week range with 159 on the low end and 286 on the high end. It is down 5% over the past year. Year to date, up 23%. So you see back here really at the end of October, it was up at 253 and then spiked down to 185 on the back of some disappointing earnings, but it's been slowly recovering since then. Over the past 5 years, up 27.5%, and over the past decade, up almost 90%. This is the least richly valued of the five, trading for the lowest multiple of these five companies, and it's by far the smallest of the five companies. Price to earnings on a forward basis is 16.5, so certainly lower than the market average. You're getting $5.40 a year on that dividend. Yield is 2.35% with a 4% short interest. So the highest short interest, the lowest multiple on the earnings, and by far the smallest company, just a $9 billion market cap. So just a fraction of the size of the others that we've discussed. Revenue's been fairly stagnant for the past few years. In 2023, you were at 11.45 billion, 11.54 billion in 2024, and for 2025, we're expecting 11.92 billion for 2025, and then in 2026, 12.45. So steady growth, not explosive, but certainly steady. EPS is expected to grow 2.3, 15.9, and 15.8% for the next 3 years. So really 2026 and 2027 are anticipated to be pretty banner years for Huntington Ingalls here. Sales growth between 3 and 5% for the next 3 years. The margins aren't nearly as good on Huntington Ingalls as the other four that we talked about. Gross profit margins of just 12.8%, net income margin under 5% at 4.76. This is a very, very capital intensive business. A lot of employees, very messy work. They're shipbuilders, right? You simply don't have very high margins on this type of manufacturing. Market cap, $9 billion, total debt, $3.4 billion, and cash, $167 million. Dividend yield is 2.35%, $5.40 in that annual distribution. It's a quarterly payer. Payout ratio, nothing substantial at 38%, 7% CAG, 5-year CAGR on that dividend, and 12 years of growth. Next ex-dividend date will be at the end of this month, May 30th, with a distribution on June 13th. Taking a look a little bit further at that dividend, here you see the yield, again, 2.35% today. That 1-year CAGR, 1-year yield on cost, 2.15%. 3-year yield on cost, 2.4%, and 5-year yield on cost, nearly 3%. Looking at the growth, the 3-year CAGR, the growth of the dividend, that is, the 3-year CAGR, 4.5%, 5-year CAGR, 7%. But that 10-year CAGR, a really unbelievable 16%. So when you look out at this dividend growth chart, you're seeing back here in 2015, they were paying $1.70, and then here, $5.25. So really, really great dividend growth when you look out over the past decade, but certainly it has been more minimal in the past few years. So we'll see if that continues moving forward. Now, if we look at the performance on the charts of all 5 of these compared against each other, as well as compared against the benchmark, which will be the S&P 500 for this, you see over the past year, by far the best performer is RTX. I keep calling it Raytheon, but RTX up 30% over the past year. The worst performer being Huntington Ingalls, down 4%. But the rest of these, you've got LHX 4%, Northrop Grumman 5%, Lockheed Martin 5%, and the S&P 500 up 12.3% over the past year. Over the past 3 years, LHX is actually negative for the past 3 years, down 3%. Huntington Ingalls positive at 13.4%, Northrop 11%, RTX up 44%, beating the S&P 500, which is up 37% over the past 3 years. Lockheed Martin coming in at 15.5%. We'll kick this out to the past decade, start to see a little bit greater separation between these names. Lockheed Martin over the past decade up 217%. Still beating the S&P 500 by a fairly substantial amount at 69%. RTX, not really fair to compare RTX on the 10-year because in their current in their current status as a company, they've really only been around for 5 years. So actually, if we looked at the 5 year, RTX is beating the S&P 500 150% to 100%. But again, looking at the 10-year, you've got Northrop Grumman smashing the S&P 500, the top performer of all of these, up nearly 266%. Again, that compares to 169% for the S&P 500. LHX over the past decade, L3Harris here up 241%, smashing the S&P 500 of 169%, and Huntington Ingalls at 128%. Looking at all of these side by side here, we already covered a lot of these metrics, but here you see them all aligned next to each other. You could pause here if you wanted to just comb through this. But again, from a market cap perspective, RTX is the largest at 174 billion. All of them have minimal short interest, but the largest short interest is in Huntington Ingalls at 4%. From a price to earnings perspective, from a valuation perspective, RTX is the most richly valued at 21.8, closely followed by L3Harris at 21. You've got Northrop Grumman next at 19.5, Lockheed Martin at 17.3, and Huntington Ingalls trading for the cheapest multiple at 16.6. You see the revenue there obviously correlates well to the size of the companies. EPS growth fairly varied across these names. It seems like 2025 is going to be a poor year for most of these companies. I mean, Lockheed Martin is expecting negative EPS growth. So is Northrop Grumman. So is L3Harris. But you see that rebounding well in 2026 and 2027. Several of these companies have mid-teens EPS growth expectations for 2026 and 2027. On the revenue growth, the sales growth, again, mid-single digits kind of across the board for all 5 of these for the next 3 years. You see the profit margins there fairly similar. The best gross profit margins is L3Harris at 26%. The worst would be Lockheed Martin at just 10.2%. Now, from a net income margin perspective, you've got Northrop Grumman at 9.2%, leading the pack, the worst being Huntington Ingalls at just under 5%, 4.8%. Debt to cash, we already kind of covered the balance sheets. Again, these are businesses that require a fair amount of debt to simply operate their businesses. But the highest debt load is RTX with 43 billion in debt. They also have the most cash on hand, 5.2 billion. But again, this is by far the largest of these 5 companies. Dividend yield, highest yield would be Lockheed Martin. The lowest would be Northrop Grumman. But that being said, Northrop Grumman also has the highest 5-year CAGR at 9.3%. And the lowest would be RTX at 6.4%. Payout ratios are pretty similar across the board. The highest payout ratio is Lockheed Martin at nearly 45%, the lowest being Northrop Grumman at 35.7%, which makes a lot of sense why they have the highest 5-year CAGR. We covered the historical performance over the past 10 years. Certainly, Northrop Grumman is blown away the competition at 213%. Now, here we're looking at the largest contracts for these 5 companies. For Lockheed Martin, they've got the much publicized, much conversed, the Joint Strike Fighter, which is another name for the F-35. That's a $250 billion contract. Unbelievable number. Really, the only one that compares would be this long-range bomber contract that Northrop Grumman has at $80 billion. Something kind of interesting to see is these RTX Corporation contracts really focused around missiles. They do have an engine contract for the F-119, but yeah, RTX primarily focused on missiles with their contracts. Lockheed Martin primarily focused on planes, some missiles, these interceptor missiles and these precision strike missiles. Looking at L3Harris, it's almost entirely radio contracts. You've got a almost $13 billion contract, $6 billion, $4 billion, all communication platform contracts. And then Huntington Ingalls, HII, entirely focused on ships, really. So 2 Virginia-class submarines. This contract here, $18.5 billion, 2 aircraft carriers, $15 billion. some amphibious warships, almost 10 billion, and then an electronic warfare contract for the Air Force at nearly 7 billion. So that kind of wraps things up. Wanted to take a look at these five. Certainly, they operate in different verticals within the defense contractor space, but all massive companies, very successful, steady business models as long as those government contracts keep coming in for defense spending, which, if you saw the most recent budget, defense spending is over $1 trillion. So I don't think these companies are going anywhere anytime soon. You saw several of them over the 3, 5, and 10-year historical performance are significantly outperforming the S&P 500, and dividend growth is certainly there. So maybe something to take a look at if you're interested and if you're not opposed to investing in defense companies. So hope you enjoyed it. Hope you learned something. Maybe you got some entertainment out of it. If you did, please like and subscribe. Thank you very much for watching. Take care. Bye-bye.